let's go ahead and kick this off formally. And it's really great to see everyone. For those who are new, welcome. So the whole reason about this sort of episode is I've been investing in the private markets for around 11 years as an LP, and life insurance is one of those topics. Personally, I've been pushing aside, and every time sort of someone brought it up, I kind of tune out. But over the past couple of years, I feel like as the investment environment has gotten more complex, I've been thinking harder on how to structure capital and have been hearing more and more serious investors talking about it differently, sort of not as an insurance, but as a capital tool. And that made me want to dig into it properly and not just dismiss it. I wanted to understand it. So that's basically why we're here today. And as always, this is not a webinar, it's not a pitch, and it's definitely not investment advice. This is a conversation. We're recording it, it's going to go out after. So if you're here live, please jump in, unmute yourself, ask questions, push back. That is the whole point of this. All right. So I brought Russ Morgan in. He's a co-founder of Wealth Without Wall Street. And I'll just say, I think Russ is probably the most knowledgeable person I know on this specific topic. He's spent years working with investors on using life insurance as a real financial tool. So Russ, man, really, really glad to have you here. And just if you can give a quick intro and then let's jump into it. Sound good?
Yeah, no, perfect. And man, thank you for having me, and glad to answer any questions and tell you where I think it fits and where I think it doesn't, right? Like we made a business that was helping people set this up, but also we've helped a lot of people become financially free doing other things. So I don't think that this has to be, I don't see everything as a nail. Like I'm not trying to be a hammer here as we talk about this, but give you a background where this came from for me. I was an investment advisor, so I was a certified financial planner. I did everything that the financial markets told me to do, and all of that broke, right? 2008, great financial crisis, right? So all the stuff that I was professionally trained to do was investing in everything except using life insurance. All my professional training actually told me life insurance was the worst place that you could put money. So probably if you have some negative connotation of it, some maybe even a personal experience, I probably could tell you I've seen it and said it in spades myself. And it wasn't until the markets crashed in '08. I was at a conference in '09, and I was kind of at the point where I was like willing to accept any new idea because the ideas that I had were not good. And I heard this guy, Nelson Nash, speaking at that event. And he talked about this concept of using life insurance, the thing that I hated probably the most at the time, to be a financial storage center for people's wealth. And so I read this 85-page book on the way home from Orlando, Florida, where I was at this conference. And then I turned it around. I don't know if my camera's good enough for you to see it. But if you notice, look at where the bottom of that book, where does it say, Latan,
I think Birmingham, Alabama, right? That's where you live.
And that's where I live. And I was like, you got to be kidding me. And so for the next 10 years, this guy was in his 70s. For the next 10 years, I made him my mentor. At first, he didn't know that, but he ultimately relinquished and said he would be. And so I learned as much as I possibly could. And ultimately what I did is I moved all my personal capital out of the investment markets into life insurance. But what I didn't know, which I think what your conversation is about and what you do with this group, is teaching people how to invest in other places. And I didn't know how to do that. I just knew that I wasn't going to invest in the investment markets anymore. And so I sat on a lot of cash, and it took me on a path to try to figure out, okay, what do I do with it? And so, of course, you know our story, but for those who don't, for the last 6 years, my business partner and I have actually shared our personal passive income report with the world. We've invested in probably 20 different asset classes. We've built over 50,000 a month in passive income. And 100% of every one of those dollars have come from a loan against a life insurance policy. So anything I tell you today is only because I'm doing it. I've seen it work personally, but it doesn't mean it'll work for you.
So I love that, and I appreciate the background. And there is the elephant in the room that you started with, and I want to dive into that for a sec. Why is this topic so polarizing? Like, why do you walk into a room of investors? I don't know if it's half, less, or more, are going to roll their eyes when you say life insurance, and the other half, or less or more, is going to light up when you say it. Why is it so polarizing?
Well, I mean, life insurance is not sexy at all. I think life insurance salesmen, as a whole, you think of the person, again, I'm going to use some names and I don't intend it, but use names people know, right? Your Northwestern rep, right? Like where you meet him and you say no, he's like, okay, well, give me 5 referrals. You're like, wait a second, I'm not buying anything. They're like,
Yeah.
I don't care, give me 5 people I can call, right?
Right.
It's like the used car salesman, like stigma. So I think there's a lot of that exists out there. There's a lot of people that never even heard of it. So that's the other probably half of the world. They're like, I don't have an experience. And then you have this small segment of the population who've actually used it as a tool. And I would tell you that 99.9999% of every one of those people you meet would say this is a fantastic thing. And I can tell you because we've helped 2,000 plus families over the years set this up. And the persistency, which in our world, that's how many life insurance policies stay on the books, is in the 99 percentile range. So it is something that they find as one of the most valuable assets they own.
And so it is an asset. Not everyone looks at life insurance as an asset because there's multiple types of life insurance, right? If there's no,
Yeah,
so can you
yeah,
talk about that for a second?
yeah. So most people have bought life insurance the way we buy everything else, like the Walmart mindset, where we try to get as much death benefit as we can for as little money as we can put in it, right? And that's term insurance. And we know that less than 2% of all term policies will ever pay a death benefit. We all hate writing the premium checks, right? Because we hope we'll outlive the 10, 20-year term that exists, but we know it's a necessity. As compared to what we do, we actually use dividend paying whole life insurance. And that term is pretty accurate. It's there. It's there your whole life. And the one guarantee that everybody on this call has, right? We can disagree whether life insurance is a good fit or not. But the one thing we all can agree on is that we will die. And when we die, right, life insurance is the one tool that can actually do the one thing that we hoped it would do when we die. And so, um, 99% of the people that come and work with us are not buying it for the death benefit, but at the same time, they know that exists. And so, for the Leslies who don't have kids and are not thinking necessarily inheritance and other things, it loses some of those other intangible benefits that maybe make it a tool that is not a good fit.
That's the death benefit of it. But the cash value of it, is that on its own worth having an asset such as it?
Yeah, so cash value, I mean, the largest owners of life insurance at the time?
No.
Banks. Just right now, go in Google or AI and type in BOLI, bank-owned life insurance. There's almost $200 billion in cash value owned by banks. Now, banks don't have inheritors, right? Like banks don't have kids. Well, why do banks use life insurance as a tool? It's in what they're called their tier one capital. That's the safest place that they have to store capital, given all the different bank regulations, right? And they can only put a certain percentage of their money in tier one capital. And so banks, some of the biggest banks you'll know, like Wells Fargo, Bank of America, Chase, have tens of billions of dollars of cash value. Actually, that will be in some situations. We did an analysis on Wells Fargo. Wells Fargo had almost $20 billion in cash value, and all of their real estate assets were only 11 billion. They're fixed assets, which is all the real estate, furniture, and everything in it. To tell you a little bit about, how they think about it.
Was that sort of was that backing the deposits? What's the benefit of having it in the cash value for a bank?
So yeah, they have tier one asset for a bank is that they have to store, right? They have to be able to protect capital and they want to put it in a place they can access it. So that's a huge place for banks. And that's kind of why, Nelson Nash, who wrote the book, Becoming Your Own Banker, he's using some of the framework there of saying, hey, banks are using these same tools, but also what do banks do? They take that capital and they lend it out. And I think that's probably where this discussion gets interesting for a lot of people is like, if I use this money, right? Like if I just put in a life insurance policy and I let it sit there for 40 years, is the 3 to 5% after tax return with the death benefit really gonna make my day? No, it's probably not, right? And that's another reason why a lot of people don't like it is because they're comparing it to investing in a syndication or any other sort of investment opportunity that has a much higher upside. But yet everyone on the call would probably say leverage is a tool that the rich get and the poor, should get, right? And what we've learned is that all we do is leverage cash values from the insurance company to go buy other assets. So we get both, not one or the other.
We'll talk about the mechanics of that in a second, but before, yeah, go ahead, Anoop. What's up?
Yeah. So you mentioned about banks owning life insurance, and I'm assuming some of that just comes from some sort of secondary market where the banks purchase policies on things that people don't necessarily want to own. And I was kind of double clicking on that a little bit because I come from the physician world, and man, I will tell you that just life insurance got a really bad rap against a lot of young doctors because of all the stuff that Northwestern and so forth has done, and yada yada. I'm actually happy with my policy, but the question I want to ask you is that if we poll physicians, for example, and I think this has been done, I mean, close to 30%, if not a little bit higher, of physicians have purchased a whole life policy or some sort of permanent life policy. At some point, they just drop it. They don't continue the premiums. They never get the death benefit. It's just a known statistic. And so I was thinking about that as someone that plans to hold it to fruition and never stop paying premiums. How do I actually find out, like, I'm assuming I get a subsidy from that. If people are never collecting a death benefit in 35% of policies, then to some extent my death benefit is subsidized by those other people's premiums. So if you are gonna hold life insurance and carry it to fruition, what is a true kind of actuarial cost, or what's a true kind of savings I'm getting by benefiting from all these lapsed policies that never pay out?
Well, I want to make sure I try to break it down in a couple pieces there. So one, my wife's a dentist, my brother-in-law's an orthopedic, my other brother-in-law is a vet. So very familiar with how much life insurance physicians as a whole buy or are sold, right? Right. I would go and speak to those groups all the time. And I would be walking in and another Northwestern rep or some other life insurance agent would be coming in. And what I would say first is, again, you have to segment. I'm not saying anything negative about most of these people, but anybody that you're doing business with as a physician, right? Like if I'm going to come to you and your specialty is X, I want to know, are you the expert in that space? Can you prove to me that you're the expert in that space? Well, in our world, who's the expert? Is it the guy who sells the most life insurance, or is it the guy who's the most wealthy? Right. And so what I would say is that unfortunately, most of the people out there selling life insurance they're just salespeople.
Sure.
They're not very wealthy. And so they're usually not set up correctly. The second part of your question was going into if you're using this and going to keep it long term, but all these other people are not. So the life insurance actuaries are actually taking that into account, right? So when you buy a life insurance policy, right, there's an expense. Cash value is nothing more than the present value of the future death benefit. That's the reason why a whole life policy, not an IUL, which there's a lot of discussion and debate around that. A whole life policy is actually contractually guaranteed where the cash value will grow to equal the death benefit. Makes sense, right? It's the present value of the future death benefit.
Right.
So it has to grow every single year. Guaranteed. Tell me another asset that's guaranteed to grow every single year for the rest of your life. Most of the things we buy get worse as time goes on, right? They depreciate. Mm-hmm. And as we get older, things get more expensive, right? So whole life policy is one of those tools. Well, part of the dividends, right? That's an insurance policy is set up with two different features. One's a guaranteed cash value. The other is a dividend. A dividend is nothing more than surplus premium, meaning you paid a premium, they didn't need it all, and the rest comes back in the form of a dividend, right? Also, better expenses,
Sure.
less expenses, mortality, all that stuff. So
Right.
your dividends will go up. Like let's say that you're part of a company and the people start getting rid of insurance policies at a higher rate than the insurance company calculated, then your dividend will improve. And so ultimately your cash value will improve. And if you're using your cash values to buy paid up additions, your death benefit will grow.
Okay.
So it becomes kind of a stacking model for you.
But Anoop, I have a question on your question then, because
Sure.
if so much death benefit is not being allocated after death, what are they doing with the cash, Russ, that has accumulated in those accounts? Are they,
Are you talking about if somebody surrenders the policy?
well, yeah, I mean, well, if people, yeah, again, I'm not familiar with the stats like you guys are, but
Yeah.
you know, if what does it mean that they don't reach, like 30% don't reach the death benefit or don't use the death benefit, or it just goes away?
Yeah. Well, so if there's cash value, the cash value comes back to the person who surrenders it.
Okay.
So like, let's just say for now you had a policy that had $50,000 of cash value and $1 million of death benefit, and you decided, I don't want to keep this anymore. You have lots of options, but the simplest option that people will take is they'll just surrender the policy and the insurance company sends you the $50,000 in cash.
Unless you have
So it's
leverage
not
that you
like,
haven't returned, right?
I'm sorry.
Unless you have leveraged it and you haven't returned the
Well,
loan.
if you have a loan, yeah, if you have a loan outstanding. So in the same example, if I had a $40,000 loan outstanding, right, they just send me the $10,000, the gap.
Okay.
Yeah.
Yeah. So
So Tom, that's what my ex-wife did when we divorced. We had we did level term when we were younger, and then thought that I'd have enough money to not need more life insurance. And then when I got into more passive investments, we decided we needed that liquidity in case upon death somebody kind of needed some of that. So we both got a $2 million life insurance policy when we were married. But then when we split, I kept mine because I wanted to continue with the things, but she just didn't want hers, so she just cashed it out. But that would be in that 30% of somebody that was planning to have it, and then in that case, the insurance company won. They just made more money because they kept the benefit, and that the delta between what she had paid in or I had paid in on her behalf, and then what cash she got back.
when you
And but
sorry, go ahead,
But
Russ.
Russ, when
well,
you talk about that, when you talk about the money going back to the policy holders in that sense, in terms of form of an extra dividend, does that only happen in mutual insurance companies, or is that with all life insurance companies with permanent policies across the board? Or do you have to be a mutual to get access to those profits?
yeah, well, dividends go to all holders. So great question. For the person who doesn't know what we're talking about, there's two distinct types of life insurance companies out there. There's what's called stock companies and there's mutual companies. A stock company is owned by stockholders, like traded on a stock exchange. Mutual are kind of like your credit union, right? So the policy holders themselves are cumulatively the owners of the company. So dividends are paid in both situations. Just in a stock company, the dividend is going to go to the stockholder first, and then there'll be some level of dividend that will probably be associated to the contract. 100% of the dividend, obviously, if you're in a mutual company, would go to you. I want to say another thing though, like
That's the
I can't
question.
remember. Anub, you said something about who are the banks buying life insurance on? There is a secondary market out there, but as far as I know, they're not buying it that way. They're actually buying it on all the VPs within the company, so all the
I
key
see.
employees.
Okay. Sure.
But there is a secondary market, and I own personally 5 or 6 different insurance policies on people that have sold them because, like in your situation, Mike, if your wife had a whole life policy for 5 or 10 years and says, "Hey, I just want the cash back. I don't want to keep this thing going," that would be a great asset, and I would buy it and have bought them. Yes, Leslie.
That's a whole conversation on its own. Let's take Leslie. Yeah, go ahead.
And I don't know if this is relevant or not, but I'll ask it anyway. I read something that 10 years from now, half of the baby boomers will have passed away. Does that, does the exit of that large generation have any influence on the conversation that we're having right now?
I don't think so. I mean, other than for the beneficiaries of all those families, but no. As far as I don't see where it would. Yeah.
Well, because the cash value, the cash is there, right? If they've made the calculations appropriate.
Yeah, I mean, the insurance companies are looking at the laws on large numbers. They know the pig and the python, right? They know where the baby boomer generation is, and they know how many of those people own life insurance policies. They know they've been accounting for those death benefit claims to happen. Obviously, there's going to be a huge transfer of wealth that's going to happen, Leslie, in that population. And for those who have built life insurance, right, that's going to create a huge, massive windfall of cash. And those heirs are going to need a place to put it. I mean, one of the things that we do, the main thing we do is show people how to use this as a tool within a thing. But there's some other planning that goes in to where we do work with, Gen 1 who is planning and saying, hey, how do I set up kids, grandkids, and great grandkids so they don't have to reinvent the wheel? And so we start having them buy life insurance policies on the next generation. They start skipping generations, and then they'll take loans against these, right? So that they'll have big loan balances. So then when the death benefit from the older generation dies, that death benefit just goes and repays all of those loans, and they don't have to, have a huge like opportunity cost of where do I put the money. So there's a lot of planning that can happen there, but I don't think that's what your question was.
Yeah, Leslie, I think the bigger concern would be something like COVID, where it was unexpected and you started to have people that were in that age cohort die sooner than planned. That's where you could have some sort of a disruption come into the insurance industry. But like
And
Russ
if you,
said, they know that. And if anything, I think the longevity, the things that we're seeing with health going forward, if anything, I think that insurance companies are probably over reserved for life insurance and maybe under reserved on annuities if we get some of the health elongation that I think is coming.
yeah, COVID is interesting because I went to all those carriers that we do business with, and I was like, man, how are you guys doing? Is the experience greater than the anticipation? And they were like, we're fine. It was actually less, right? So it's kind of, I actually own a life settlement fund, and out of the 20 lives, which is on insurance policies on other parties, right? We lost none of those people in COVID. It's crazy that obviously there was a lot of deaths in COVID, but the expected death were not any greater. There was some, and I think in some of the term markets within something like the group term or whatever. But
Alex, did you want to ask a question? So you want me to yourself?
No. So basically, you talk a lot about the whole life, and then in the beginning you were saying, oh, it's not like IUL, and then I've heard about VUL. And can you just briefly kind of touch upon like what's the biggest difference, and is the whole life just really a matter of like something that's guaranteed versus like VUL or IUL was something that's depending on the market and a little bit more risky? Is that basically the gist of it?
yeah, I'll give you the details there. So one, when I got in the investment space, any life insurance we sold would have been VUL, right? Which is using term insurance and putting an outside investment together. So whole life goes back 200 years. In the early probably 1979, 1980, universal life came on the market. And the reason it did is that for those of you old enough would know that interest rates spiked, and people who had whole life policies that were earning 8 or 10% at the time, which we'd all take those today. But at that time, that was a fraction of what interest rate. You could get a CD at 16%. So basically all the companies pivoted and started what was called a universal life policy, where they could take out the cost of insurance and then allow you to invest in a side entity. And so at the time, they started using actually bonds, junk bonds. And there was a big bubble that happened in there. And so that crashed. So then right after that, the stock market started to grow in the early 80s. Most people know why it grew. If you don't, the reason why the stock market had such a boom in the 80s is that the invention of the 401k became the availability to the average person to get access to the investment markets that they really never had in the past. And so you had this huge run. Well, of course, now everybody who was in the insurance world says, hey, we don't want to invest in bonds anymore because they're no good, but we need to get involved in the stock market. So they created what was called VULs. And it's the same thing, just term insurance with a side account, which is the stock market. And that ran for a while until you had 2001, everything else. And so people said, oh, I don't want to, experience that sort of loss in my account like you did in that space. Can you create something else? And so then they created another, cousin to it, which is called Index Universal Life, that gives you some of the upside, but not all of the downside. But again, the whole premise is that the chassis is built on a rising cost. And unless the market keeps going up, and if the market can keep going up at a faster pace than the cost, then it looks good. And it's just one of those tools where for people who investing that, it is truly an investment. And so if you're saying, hey, I want to invest in this instead of real estate or instead of this other project, knock yourself out. If you're saying, hey, I want to use this as a tool, as a leverage point to go invest in other things, I wouldn't do it. That's the reason why we use whole life, because that's our goal.
Okay, so when you say life insurance, you specifically talk about whole life.
I'm
That's
specifically talking about, yeah, whole life.
okay.
Yeah.
So there's a question here from
Russ,
Brian. If you can give an example of how you arbitrated cash value into different asset classes and how you've seen success. I mean, I assume I know the answer more or less, but you want to shed light on that?
Yeah. So what we do is we will go to our cash value. We'll borrow against it. So for those of you who don't know how that works, we go to the insurance company. Say I have $1 million of cash value. Go to the insurance company and say I want to take $100,000, invest in this new syndication, as an LP. So what they'll do is they'll basically put a lien against my cash value for that 100 grand. And then they send it to me and I go and invest in the project. I personally am only looking for cash flow. So I'll take that cash flow that comes and I send it back as a loan repayment. The insurance company will charge me loan interest on whatever amount is outstanding, but I don't actually get a bill in the mail. So it's not a required payment. So it's an unstructured payment. It is an interest only payment, which is rare in these days, right? Most of the things we deal with are amortized payments, but in the insurance world, it's all interest only. And it just repays. So another key point is when I take that 100,000 out, they reduce my death benefit by 100 grand. Remember, the cash value is nothing more than the present value of the death benefit. So I actually spend my death benefit when I'm using this 100 grand. So if I died a day after they gave me the money, all they're going to do is take the death benefit, subtract my loan value, and send that to my heirs. But as I send the money back, it repays the loan, right? And then I get access to that money again, and my death benefit goes up by that amount.
And you use that loaned amount to go and invest, and that's how you create the arbitrage cash value.
Yeah.
Russ, can you kind of run through this scenario for me? So let's say that I'm in a cash building or asset building stage, and I'm going to take that 100,000 and walk us through putting it into sort of washing it through a policy first. How much is left for me to then be able to pull out and then invest in that deal versus going directly with that 100,000 into the deal? Because I know when we were talking on our pre-call, you were saying that when you look at both buckets, the inside the policy and outside the policy, you actually eventually end up ahead. And I've had trouble getting the math to show that way. I see the inside the policy getting ahead, but when I consider my costs of, repaying that amount outside versus not running it through the insurance, there's always been a drag. And so and I'm still doing it. I have a policy because for me, I needed it and I see it as a financial tool. Plus I needed the insurance. And so it's a benefit, but I've always seen that drag, but I know when we were talking, you said that there wasn't. So I'd love to see you kind of walk through that scenario for us as an investor who's trying to increase net worth in the long run.
I shared this with you guys yesterday, but I think it's pertinent. So this is an insurance policy. The very first one I set up on myself. I had actually bought one of my wife the year before, but so this is 2010. This was the most recent statement came in this year. So currently that one policy, and I have over 25 of these now, has roughly 300 grand in cash. To your point, Mike, really good, is that the biggest heartburn for all of us is that if I start any new thing, what is the startup cost? And so life insurance is not null and void of that, right? So if you put in, and this is the chart I kept up with over the years. This one policy, when I first started out, I put $25,000 in, and I had access to like 16,000 and some change. So if I'm looking at investing 100 grand today, and I want to know in the next, 5 years, 10 years, whatever, like if I invest 100 grand, or in this situation, I would invest it like 75 or 70 grand or whatever it is. I'm gonna have more in the first thing. And so that's always what people will talk about. And I agree 100%, is that there's a startup cost to doing this. And so you notice in I don't have an arrow there, but you notice in year 2, I put in 25 grand, and how much I had access to was a little bit more.
Are you sharing a screen or something? Because I'm not seeing it.
Yeah.
Are you not seeing it?
Well, I'm seeing it.
Yeah, I see it.
Okay.
I see it too.
I'm sorry. So
Wait, hold on.
2,
Is anyone else not seeing it?
No, it's there.
Okay.
year 2, I did the same exact thing. I put in 25 grand, and I had access to a little bit more of that year's cash value. Obviously, I had access to the year before too, but combined, right? So to your example, Mike, if I would have put in a 25 grand into a deal, right, I would have had 50 grand into a deal versus 30 something thousand dollars into a deal. And the same thing would have been true in year 3. I would have put in 25,000. I had access to 22 or 23 or whatever that number is. And it wasn't until year 3 where the actual growth on the cash value that one year was greater than what I put in it. And the easiest way to think about this mentally is that most of us are putting money in cash and then turning around and investing into a deal, right? That's how we operate. We're using some sort of clearing account. Most of it is a checking account. So if you look at the black as your checking account, and then you went and invested, which is not on this page, that money's there. The checking account is the internal part. Obviously, if you took 25K out of your checking account, you're going to have 0 in it at the end of the year. Internally in the insurance policy, we do have growth, right? Greater than our checking accounts. And that's what's happening is that these years, right? I'm getting this slow growth. The accumulation of that has actually had that year's cash value grew by more than what I put in. And then the next year grew a little bit more.
When is when is the accumulated amount sort of surpass the contributed amount?
So when is all the black that I put in equal the green in essence?
Right.
It varies, depends on age, health, and so forth. For blanket terms, I'll say most people around 7 years, but
Okay.
it may be, it could be less, it could be more. There's so many variables that could change that. So you can see over the last, I don't know, whatever that 10 years of me doing this, is that the cash value growth that year was greater than what I put in it, almost double. So I was behind these first 3 years just immediately. And then there was some cumulative behind because, that has a head start. But then basically for every year there since, I've been able to, if I was taking the same dollar and putting in there, I was able to put $2 into a deal instead of $1 into a deal. Where over here, I was only able to put in 60 cents into a deal versus $1, 65, 75, right? Then it became 105, 110. Now it became $2 over here. So when I say that eventually it will get there, right? So the thing I don't know is how long we'll live. So long enough, I will be putting in $2 in this account that we're buying an asset for $2 versus $1, and I'll eventually catch it. It's kind of like the idea of if you were racing one of those Olympic sprinters, and they gave you a head start. Well, you're ahead. But if you race long enough, I'm a big Braves fan, and in the games they have this guy called the freeze that they let them have like a 10-second head start from left field foul pole to the right field foul pole, right? And that person gets all the way across center field, and they're running, they're doing everything they can, and 99 times out of 100, that guy catches them and passes them by the finish line, right? That's really what happens here. Now the other part is people say, well, what if I die in year 10? I go, well, it beat it, right? Because when the death benefit comes in, whatever that death benefit check is going to be significantly greater than the smaller percentage amount that I was ahead in my investment deal. So it does beat it. And again, I don't know how long it beats it while you're living. I know it beats it when you die, but in my situation, and I analyze this, obviously it's a better deal. The other part to this that we forget about is that when we invest, those dollars start coming back. Where do those dollars go? They go back to that checking account. Can you reallocate 100% of every dollar that comes back? The answer is no. Those dollars sit there. So those dollars sitting in cash, we don't calculate what the opportunity costs on those dollars are, right? We don't know how many dollars have sat there for how much time, and that never gets calculated into anybody's spreadsheet. But see, I don't have to calculate that because I have it. My calculation is this: I have both and so that's one of the hard parts for people, is that we're not working in a vacuum. We're dealing with human behavior. And while you may flow every dollar today, but we go through COVID, how many dollars flowed, right? Who went like this and took all those dollars and stopped all investing and just held on because we were scared. We didn't know what the crap was going to happen. So human behavior applies to this too. And it's hard to put a scale on that. What was the math? So for me, again, I just, if I have a windfall when I sell an asset, I just go pay back the loan. I don't have to think about what the deal is.
So we have a question here about, and I see your hand up, and we'll get to you in a second, about tax deductibility for loans against your cash value.
Yeah, I'm not a CPA, so I'm not going to give you tax advice. I can tell you what I have done. I am deducting the interest expense against interest income. So for most of us, we're investing in projects that's creating some level of income. So if you borrow against anything, it doesn't matter if it's an insurance company or a bank, and you invest it in your business or into an investment, you can then write off some of the gain against that expense. And so there is a way to do that. You just need to keep up with it. You need to talk to your tax professionals about it. But yeah, I've done that.
Okay.
Sure.
And if we're already on taxes, I have a question then as well, because when Mike was talking about withdrawing your cash value, are there any tax implications when you do that?
Well, you used the word withdrawal, so we need to clarify our terms. So if you withdraw money, right? Withdrawal is taking out basis. So you can take out up to what you've put into it. If you withdraw over and above basis, then you're subject to taxation just like other accounts.
Okay.
Loans against insurance companies,
Nothing.
like loans on anything, are non-taxable.
Right.
Yeah.
Yeah, that's the tax benefit of this. And Brian was talking about his CPA allows to deduct interest expense if you use the cash for investment. So that's aligned with what you said. All right, Anoop, what's up?
Yeah.
So I had a question about, using that loan mechanism, and I'm going to kind of use an existing policy I have. It's through Northwestern Mutual. And so I was looking at the policy loan rate. I think it was, I don't know, somewhere around like 7%, maybe it's 8%, but I think it's 7%. And I'm just thinking to myself, compared to, really a stable and excellent source of collateral, which is the cash value of that policy, that's a pretty high rate, compared to doing like a, securities-based line of credit or whatever it is. And that just never made sense to me. And I was a little bit worried about utilizing that for two reasons. Number one, it's a pretty high hurdle rate if you're going to reinvest the money at, if you're paying 7% to reinvest versus 4 or 5%. The second thing that worried me a little bit was if I took a loan, then the loan would be kind of a direct recognition loan, I think is what it's called. So whatever I take out, it's being cut off against my dividend. So I'm not earning as much dividends as it would otherwise. And then I was wondering, if I went to an outside bank, like what outside banks would actually loan money against the cash value of my Northwestern policy, and what type of rates are actually out there that I can reasonably achieve. And then the last question is more of a structure question. So if I put a policy inside of an ILET, like we have a survivorship ILET that's basically second to die, me and my wife, but the ILET beneficiaries are the kids. And so if there's a loan from the policy and the loan goes to the trust and the beneficiaries of the trust are the kids, how do I use that to buy myself a car or whatever it is? It's never coming to me. It's going to go to the outside beneficiaries, which is not the insured. So how does that work in real life if I want to borrow from a policy that I'm not a beneficiary of the ILET trust?
Yeah. So the first, hopefully I got all of them. I started writing them down late. Interest rate.
Sorry, a lot.
No, it's okay. I love the questions. Interest rate. So every carrier has a different interest rate, and Northwestern Mutual is one of the higher ones. I do have one Northwestern Mutual policy. Northwestern's a weird company because you have to be an employee of them in order for you to sell their insurance policies, and I don't want to be an employee of anybody. I'm not qualified to be an employee. So I actually went and bought an insurance policy as a life insurance agent from another life insurance agent because I had so many clients that were in the physicians, dentists, whatever, that had Northwestern Mutual, and I wanted to know how they worked. And so I bought one and have used it. I've had it probably for 11 years now. And they do have a high interest rate. You also, within the interest rate, so a couple of things. Insurance companies, mutual companies, they have to make money one of many ways, right? One is that they can make, and the first and foremost is they give you a loan and you pay them back. This the cheapest money, the cheapest way that they can do it, because there's no management. I mean, they can have a $15 an hour employee or less manage that transaction. There's no risk, right? You don't pay them back, they reduce your death benefit. That's their liability. So it's huge. The other place they'll do it, if you don't take the money, they'll go put it in different commercial bonds. The next place is that they're typically own a lot of big, huge commercial real estate. Most of the large buildings in most downtowns are owned by insurance companies, and they have these, AAA leases, and that's how they cash flow, right? So they're always looking for cash flowing assets that are as safe as possible. So less than probably 1.5–2% of their money is in anything super variable. So you won't find them investing in, the stock market with 50% of the money kind of thing. So when they charge you that higher interest rate, you do get the benefit of it, right? The dividends with Northwestern Mutual are great. One of the reasons is because they have high interest rates, right? So it's a trade-off. So your internal growth inside of your contract will probably be at a higher level than the average insurance company. So the lower the interest rate, lower dividend as a result, if they're getting a decent amount of their business from that investment asset. You mentioned a very detailed question. Some people, this is going to lose them, but you talked about direct recognition versus non-direct recognition. For everybody who's trying to learn, if you have a company that's direct recognition, they just recognize you have a loan. So some of your money is in the cash value that has not been loaned. Some of the money is in the cash value that has been loaned. And a direct recognition company says, we recognize you have a loan. And as a result, we're going to make adjustments. Now, you assume that the rate would be less. That's not always the case. So if they're charging you 8%, but their average portfolio, which right now is probably in the 6 to 6.5 range, for the money that you would have as a loan, they would actually recognize that as a surplus. So your dividend specifically for that loan money would be higher because you're actually adding to the surplus of it, right? Now, good or bad, right? So a non-direct recognition company says we don't recognize any of it, but they have to pull other levers in order to make up for that. So again, I don't get really caught up in that. I own both direct recognition and non-direct recognition. I think it's more nuanced than anything. But the interest rate is important. So if I think that I can borrow money from someone else at a cheaper rate than I borrow it from my insurance company, do I do it? Yeah, absolutely. The house I'm living in, I don't have this borrowed against my life insurance policy. Now, I built a lake house. I had over $1 million in cash in it at one point. That was a loan from my insurance company because the bank didn't want to give me that amount as I was building it, right? And so I decided to put that capital in. And then as soon as they said, okay, we'll give you a line of credit on it, I pulled that money right back out and went back. Some of us, we'll find an opportunity. They say opportunities find cash. Well, if I don't have access to cash, right, the insurance policy gives me immediate access. I go do the deal, and then I find the cash from somewhere else, and I repay it. I can do that. So the insurance cash value is always the easiest money for you to get, because if you've ever taken a loan, it's like, I want this amount, I want it sent here, and within a couple of days, it's ACH into your account, right? There's not thousands of pieces of paper that you're signing and millions of questions you're answering. So there's a huge benefit that we get from that. Another thing you asked, which is really insightful, is that are there other banks out there that lend against life insurance cash value? And the answer is absolutely. So I have $2 or $3 million in cash value that's actually as a collateral asset at a bank, and I have a lower interest rate because I mentioned 25 whole life policies, and I got in my business, my personal life, and all these different things, and that became kind of cumbersome to keep up with all that stuff. So I went to a bank, I collateralized them, and then I have a line of credit. So I have a checkbook sitting behind me, our ACH, the old days checkbook, but I still have a checkbook. And I just write a check against it. And so, yes, the rate has been actually over the last year up until a couple months ago was higher than the rates at the insurance companies. But a couple years back, those rates were lower than the insurance companies. So those rates are variable, right? Insurance companies' rates don't move a lot. They're really slow to move. So it depends, right? Sometimes I can arbitrage and get a better deal at the bank than I can at the insurance company. And the beauty is I could just refinance them back and forth if I want to.
Right.
Just
The last thing he mentioned is ILET. Uh, your ILET is not a place for this because your ILET is intended for you not to be able to touch it, right? If you could touch it, that means that it's not truly an ILET. It means that you know all the state benefits and stuff like that. So I'm not a big fan of ILETs for this purpose.
Russ, quick question because we're also at time here, but is there a certain age, like is there a rule of thumb for a certain age where, doesn't make sense at that point to, open a new policy, I don't know, 60, 70, or is there an age? Because I've had people ask me that question.
Yeah. So my mentor died. He was 85 years old. He bought an insurance policy 2 years before, or 2 weeks before he died. But he had open heart surgery when he was 55 and couldn't buy an insurance policy on himself. So the answer
Yeah, no,
is
but I agree.
buying
But
it
if
on
the
yourself. Yes,
if-
I mean
if-
there is. It depends, right? So
hold on.
we have
Let me clarify. If the objective is to benefit from all the great benefits that a life insurance policy has, which means you can, lend again, you use it as collateral, you can get money out without taxes because you get a loan, all that stuff. Like, is there a certain age?
But you would have to tell me all the scenario, right? So like the person people think in traditional insurance terms, I want to buy an insurance policy on the youngest person, the most healthy person ever, right? Because that makes the insurance cost less, which is a true statement. The problem is you can't put much money into it. The insurance company will limit the death benefit. So I go buy an insurance, I have 2 policies on each one of my 4 kids, right? I can only put in 10 grand a year into each one of those policies. I'm putting in 20 grand a year into their little policies. But that's the max the insurance company would let me do because it bought so much death benefit because how young they are versus their mortality, right? Insurance company won't give them $10 million of death benefit. But a 70-year-old is that much closer to mortality, right? I could put in 100 grand and only buy maybe a $300,000, $400,000 death benefit policy, right? Which they would be willing to underwrite that person potentially for, assuming they had the assets or income or whatever. They're that much closer. So the cash value actually will grow pretty similar for a 10-year-old as it will for a 70-year-old. The death benefit is going to be dramatically different. Now, again, lots of factors can go in there, health and other things, but also what am I trying to do? So when I have 70-year-olds who come to us, I'm asking that question. What is your major objective? Is it cash value growth? If that's it, then I say, well, why don't we buy it on your grandchildren? Right? We're just going to put less in. If I'm like, are you trying to set up the next generation? Because when you die, right, we need to flood capital. Like, is that the goal? Okay, well, maybe it's on you. So there's so many other factors. I love that we want to think about this always in spreadsheets, but our life is not in spreadsheets. Most of the stuff that we deal with, the human behavior, you can't put on a spreadsheet. And that's the reason why this frustrates people so much, because they'll tell me all the reason why it doesn't work. And I'll be like, let me show you the thousands of ways I see people using this that you hadn't even thought about. And most of this is human behavior type stuff.
Right. All right. Any last questions? Anoop, you had a question?
No. Good.
I have a question. So
Alex, hold on.
I've heard about.
Sorry. Let's have, because Rob hasn't asked anything yet. Let's have Rob.
Oh, sure.
Then go ahead,
That's
Rob.
fine. That's fine.
An explanation on how the interest is assessed, how often, it's not compounded exactly. It's simple. So how does that work in comparison to like going to a bank and even borrowing against your policy there?
Yeah, so the loan interest starts out as simple interest, Rob, and it's just outstanding balance. So if I had $1 million or $100,000 at 5% or whatever, I'm going to pay that $5K in interest. But if I start paying it back, obviously it's going to be less throughout that year. But if I leave that balance, let's say I had that $100,000 loan and I didn't pay any back, then they would assess that 105, and now that interest did compound, right? And so next year I'm paying interest on 105 instead of 100. So it is simple interest, but if you don't pay it, then that interest gets calculated and then becomes compounding.
And as it goes down, is it just assessed at the end of the year or whatever.
Yeah,
And
on your
so,
policy anniversary is when they say the only bill you ever get is on your anniversary. They'll say, here's what the interest due is. You can pay it. If you don't pay it, it will just compound on top of your loan balance and keep rolling.
and if you pay back some of the principal right before that date, that's
Yeah.
going to shrink
Yeah.
the interest.
It
Okay.
shrinks it and gives you access to the money, which is the beauty of this. Most of the loans in our life, we see loans is that when we pay large lump sums of money toward the banks or whatever, we don't pay them off. We don't get access to cash, right? But I can put $100,000 loan repayment, and then the time reaches out to me and tells me about this amazing deal that I should go in with him. I can call the insurance company back and get that 100K right back to me. I don't have to play the games with them. So the flexibility is huge for sure. That's how it would definitely differ from a bank.
So, Alex, you want a short one or you want to just reach out to Russ afterwards?
Hopefully it's a short one, but
Let's go.
I'm more than happy to reach out after. So obviously I have two kids, and there is this thing floating around about using life insurance or whole life insurance, and especially like the infinite banking for college uh, fund instead of like using a 529. Is that something that you've seen done successfully, or is that just a sales pitch?
Probably a little both. I mean, again, how you use it is important. So, I have a daughter in college. I didn't use a 529 plan, even though I help a lot of people early on in my career set up 529 plans. But by the time they got to the point where I'd learned this, and when I was going to start saving for it, I just started insurance policies on them. She got a full ride. And man, I'm so
Hmm.
grateful. I'm so grateful that I didn't have a 529 plan for her, because that money, right, she's not able to use because she doesn't need it. And
Correct. Like
so,
that's, yeah,
right,
the flexibility of five. Well,
yep,
520 is a lot more restrictive as to what you can use it for. Right?
yeah. So what have we done? That same daughter, we bought a short-term rental for her, and we bought her a Turo car, both of which she used to create passive income streams. The Turo, we learned a lot of good lessons that we don't want to relearn, but those are business lessons, right? There's things within that. So it has a place, right? I think just considering the situation has a place. Um, it I don't know, for anybody at the time that wants to reach out or whatever, I just put a link in there, and they can jump on a call with somebody if they want to.
Awesome. Yeah, we're at time. I love this. I mean, we went over by 15 minutes, but still, it's an interesting conversation, a lot of questions. Russ, man, thank you so much. I really appreciate you coming on, man, and being so
No,
open. These are
Yeah,
exactly the kind
thank
of
you.
conversations I love, like people asking questions and interested and you getting really good answers. So appreciate that. We're going to send the recording of this after the call to everyone. And next week we have a good friend of Mike and I and mine, Hans Box. He's one of the sharpest LPs we know. He's going to join us to, pull apart how private market decks, investment decks, how they frame risk, what GPs show, what they hide, and how to spot it. It's going to be a good one. So I'll be sharing that. We'll get together with the recording. That's a wrap. Russ, again, thank you so much. We'll be in touch, man.
thank
And
you.
for the rest of you, have
I
a great
appreciate
rest of your week.
Thank you.
it. Thank you.
Have an amazing day.